Okay, we are going to look at problem P2-1 on page 64, chapter 2 of our Governmental and Nonprofit Accounting Theory and Practice book, 9th edition. And in this particular example problem, we are analyzing the effects of the following transactions on the funds and non-fund accounts of City of Nancy. Identify the fund that would typically use to record the transaction, and B, indicate how each transaction would be reported in the operating statement for the fund expended. So the very first example there, we had $8,000 that was received for licenses. So we had increased our financial assets by $8,000, and we increased our fund balance by $8,000 under governmental funds. And now, how would we report it? We have revenues of $8,000 are reported in the general fund, statement of revenues, expenditures, and changes in fund balance. So that's what we're doing. We're going to look at each one of these transactions, see where they go. So our first transaction is salaries and wages for firefighters and police officers incurred but not paid, $75,000. Well, since we did not pay them, not a cash thing, first of all, what fund are we going to be in? Well, we're going to be in the general fund. Then we are looking at, we didn't increase the assets, so let's look at the liabilities. We increased our related liabilities to $75,000. And that will be a credit to our fund balance. Okay. Our actual transaction, so what did we do? Well, we will be reported as an expenditure. Expenditure of $75,000. And again, that's reported in the general fund. Okay, so that's all that's to that particular one. The second one, the city borrowed $9 million to finance construction of a new city executive office building by issuing bonds at par. So we are going to look at it. This is going to be a little different. We are still going to have, we're going to be hitting our capital projects fund. Okay. So our governmental funds are actually going to increase by $9 million. Oops, extra zero there. Fund balance increases by $9 million. And one of these times I'll get the right amount of zeros. Next, we are going over to our general capital asset and long-term liabilities. We are going to have a $9 million long-term liability to record those bonds. We are also going to have a negative fund balance in our general and capital asset group. Okay, and then we are going to, and the other thing's going to be happening, we're going to have our other financing sources. The bond proceeds of $9 million, which will be reported in the capital projects fund. Okay, so we broke that out by our funds, recorded our liabilities, and to where they all belong. Okay, next, the city paid $5 million to the office building contractor for work performed during the fiscal year. So we are going to, the fund is going to be, again, the capital projects fund in our governmental funds. Remember, governmental funds are broken into different segments. Capital projects fund, we're going to subtract $5 million for the cash we paid out to the contractor. We are also going to reduce our fund balance then by $5 million. So out of that $9 million, we have $5 million that we have spent. Okay. Will that affect anything else? Well, yes. It's going to increase our general cash assets, our general assets for our general capital asset funds, or general capital assets, 5 million. Serious zero problems this morning. Okay, and we'll also increase our net assets by 5 million. Okay, so that's recording that we're building on the asset part. Okay, so we've got our asset group going, increasing as the value of that building increases. In the governmental funds, we've spent it out of our capital projects fund. And our description is expenditures of 5 million. Which is going to be reported in our capital projects fund. So that's just kind of detailing what we did up here. Okay, next. We have the city purchased several notebook computers by issuing $60,000 6% 6-month note to the vendor. The note is due March 1st of the next fiscal year, which is the calendar year. Okay. The note is considered a fund liability. So this is going to be, since it's not a capital thing, it's going to be a general fund. And our general fund, we're going to have a liability of $60,000. Our fund balance would decrease by $60,000. Okay. Our general capital assets will increase by $60,000. And our net assets will increase by $60,000. Now notice we do hit, in governmental accounting, you hit more than one fund on the same transaction. Okay, so what we're doing here in the general fund and the capital projects fund affect our general capital asset and long-term liability groups. Okay, always need to remember that. So on number 4, our description is going to be, we're going to have our expenditures reported in the general fund. Why my font went weird there. Okay, our expenditures expended during or in the general fund. Hey, the other part of that is at the end of the year we are going to have to pay our interest. So we're going to have expenditure of $1,200, which is calculated by taking 60,000 times 6% divided by a third. Okay, so that's for our interest, and that's in the general fund. And up top, we're going to make it look like this. So again, still has our general fund. We have a liability of $1,200 that we're going to have to pay. Our fund balance then, of course, is reduced by $1,200. Notice nothing happened in the capital asset fund. Okay, so our general capital assets stay the same. Okay, let's move to number 5. General fund resources of $8 million were paid to a newly established airport enterprise fund to start up initial capital. Okay, so what we're doing is we're transferring funds. They're transferred to the other fund from the general fund to an airport or enterprise fund. So how we're going to do that, describe that, is we're going to have other financing uses, so which would be a transfer to other fund. We have transfers among funds, quite a bit, of $8 million, and that's going to be reported in the general fund. And then the other part of that is going to be transfers from the other fund of $8 million. You know what I mean? Serious zero problems, my goodness. Transfer from other funds into our airport enterprise fund. And enterprise funds are run on a for-profit basis, basically. And so this is still going to be 5. And up top, our entries are going to look like this. We're going to have our general fund, which is going to show a decrease of $8 million, which is transfer that money out, which of course then will reduce our fund balance by $8 million. Okay, and that's it. Our airport fund, so we're going to set up an airport fund here, and we're going to have $8 million in cash assets. Okay, and then our net assets for that are going to be $8 million. Okay, so we established that. Notice the account's set up a little different. We have current assets, non-current assets, current liabilities, long-term liabilities, and net assets. So those are run more on a for-profit basis. This is enterprise. It's our enterprise fund. Okay, now let's look at number 6. 3 million personal injury lawsuit has been filed against the city. Controller determines a probability of judgment will be amount to $2 million in the future, but does not expect to have to pay the judgment for another 3 years. Incident relates to general government activities. So we're going to, there's no operating things that are going to happen here. The fund is actually going to be recorded as a $3 million liability in our governmental liability fund, and a credit to our net asset of $3 million to there. So basically we're recording a contingent liability in our general capital assets and general long-term liability accounts. Okay, so that's what we are doing. In 6, there's really no operating statements prepared for those funds. No operating statements. Okay, then let's look at number 7. The city repaid half, $10 million of general obligation bonds that have been issued several years before to help construct final construction of school building. Interest of $1 million was matured and paid. So we're going to have expenditures. So here we're going to have 7. We're going to have expenditures is of $11 million. Are reported in the debt service fund. And up here, we are going to have our debt service fund. We'll have $11 million paid out in cash. And our fund balance in our debt service fund will decrease by $11 million. Okay. On our general long-term liabilities, our liabilities will actually decrease by $11 million, and our fund balance, our net assets will actually decrease by $10 million, or excuse me, increase by $10 million. It's having the opposite effect. Okay, so we've paid off our liabilities there. Okay, and then the interest goes into the this paid just like normal. We've already accrued that. Okay, so, and then finally, I don't know if we have enough time for this because I'm blocked at 15 minutes. The city sold capital assets original cost of $50 million, a $1,000 book value of $500 and no restrictions. Basically, we're going to record the cash in the general fund for $1,500. Increase our fund balance increases by $1,500, and our general capital assets decrease by $1,000, which was what the book value of it was, and our fund balance will increase by $1,000. Put this one in the wrong column. That should be in there. So there we go. That is our transactions for problem 15-2-1.